Joining us now is Peter Schiff. Needs no introduction.
Thank you.
Euro Pacific Capital. You know him, you love him.
Well, they might love me.
Well,
some people love me.
Some. Yeah. You are polarizing.
Yes.
So I'm just trying to think where we want to start. I mean, you're known as a gold guy. You're known as a big picture guy. Where do we start? Because I think you said that what's building up in the markets now, the type of bubble that you perceive is maybe bigger than '08.
Well, it's the same type of bubble, it's just bigger because the source is the same. It's artificially low interest rates, it's quantitative easing. The central bank, the Federal Reserve, is responsible for the rise in the stock market. You know, in 2018, or 2019 rather, corporate earnings actually declined slightly, yet stock prices were up about 30%.
There's also multiple expansion.
Yeah, but that's all the Fed. And if we really had a good economy, you would have expected corporate earnings to reflect that, but they didn't.
And what they're doing in money markets right now is I think one of the Fed governors admitted it's kind of like a Fed, it's sort of like a QE light in a way.
It's not QE
light. It's
light.
a derivative.
It's actually QE extra, because they're doing more QE now than before. The only distinction they're making, which really is a distinction without a difference, is that the last time they did QE, when they were doing QE3, they were buying longer term government bonds. Now they're buying shorter term government bonds, but they're still buying government bonds. They're monetizing the debt. Their balance sheet is expanding. And so it's quantitative easing, whether they want to admit it or not. And you know, the reason they don't want to admit it is because they had to do QE when we had a great recession. Now they're pretending we have a great economy, yet they have the same monetary policy as when the economy was lousy.
Go back to the mid-2000s where you were talking about a housing bubble and this is all going to end in a mess. You were a voice in the wilderness for a long time. You turned out to be right, as did a few other people. And now it seems like a similar situation. You're a voice in the wilderness because the markets just keep going up. So how do you make those comparisons, or can you?
Well, it is very similar because it's the same dynamic at play, and the same people who were fooled by the illusion prior to '08 are being fooled by it again. You know, I think the difference is, personally, I got a lot more airtime on the mainstream media leading up to the '08 financial crisis. I was on all the time. Every week I was at least on CNBC or CNN or MSNBC or Fox or Bloomberg. I was on constantly making my case that it was a bubble and that we were headed for a crisis. This time I'm really pretty much absent. So you don't hear my voice in the conventional media, you know, crying about this crisis. I mean, you can hear me if you follow me on social media. So before 2008, I really didn't have my own platform. I didn't have a podcast. I wasn't on YouTube or Twitter or all this. So now my voice is getting out there, my opinion, but only, in kind of the underground, right? Through the internet,
right. Not
through the conventional sources like it was before.
So Peter, you were saying off air that CNBC just stopped having you on. Why do you think that was?
Well, again, you have to ask them, but I mentioned the same thing with BNN. You were associated with them. They don't have me on either. So it's not just in the US. In fact, I used to be on CNBC Asia and CNBC Europe all the time. They stopped inviting me too. I don't know if they coordinated it or what. But look, I think they have a vested interest in perpetuating this bubble. I think when I was on earlier, when they would have me on in '05 and '06, it was like, hey, who is this guy? I don't know, he's kind of good for ratings. And it lets us show that we take the opposite side. We show both sides, even though like it was me and then 9 other guests would be bullish and they would have me as a bear, like a token bear.
Right.
But I think I gained a lot of credibility and some kind of notoriety. And now they kind of don't want to give me a floor. And I think a lot of times, they go back and they look at that Peter Schiff was right video and they don't want to create more footage for the next one. Like, hey, we don't want to be on with this guy,
right.
Because we know eventually we're going to end up looking foolish when it turns out he was right and we were, just as wrong. So they just kind of ignore me.
All right, lastly here, Peter, we're at VRIC, we're at a mining conference. People want to hear your opinion on precious metals, gold particularly. Palladium's had an amazing run, probably some different fundamentals driving that, but we often hear, gold's going to 2,000, 5,000, 20,000, and that gets to be a very tired story, especially since 2011. We haven't seen it. Yes, it's bounced up a little bit, it's done better. What's going to drive it, and are we going higher, and when?
Well, I mean, it's no surprise that I think gold's going higher. I mean, I've been bullish on gold for the last 20 years, and we've been in a bull market during those 20 years. People just, look at what's happened relative to the peak in 2011 because we got up to 1,900, but we started that 10-year run under 300. So that was a huge move in the price of gold. And obviously gold price got ahead of itself somewhat in 2011, but the reason it corrected the way it did, down to 1,000, was because everybody began believing that the Fed was going to be able to normalize interest rates and shrink its balance sheet, and so the markets began to discount that into the gold price. Well, now people are finally discovering that they were wrong to have believed that QE is going to go on indefinitely, that interest rates are never going to normalize, and during this environment, gold has quietly moved up by 50% over the last 4 years. That's not a bad move. And gold stocks have beaten the S&P over those 4 years. In fact, gold stocks beat the S&P last year. They beat the S&P over the last 2 years. Interestingly enough, gold stocks are down this year, even though gold prices are up, maybe 2.5%. And I did a little research quickly. The last time this happened in January where you saw this strong a gold price, but weakness in the gold stocks, was January of 2000. And that was at the bottom of the 20-year bear market in gold.
Right.
That was at the peak of the NASDAQ bubble. And on that environment, you had a lot of bearishness still left over for gold stocks. But here we are now. Why is there so much bearishness on gold stocks? I mean, everybody is bullish except when it comes to gold stocks. I think this is a great contrarian indicator that these stocks are still really cheap. In fact, I just mentioned that S&P earnings were down last year. Gold stock earnings were way up. Even though gold stocks went up more than the S&P, their earnings went up more than their price. So while the S&P is more expensive than it was at the beginning of 2019, gold stocks are actually cheaper, yet people aren't buying them. So I think this is a great opportunity. People should be buying these stocks.
All right, we'll see what happens. Thanks for doing this, Peter. We appreciate it.
All right, sure, my pleasure.
All right, Peter Schiff, Euro Pacific Capital.